Okay, now we're on to the ECB. This, I think, is a central bank that perhaps provides the greatest number of opportunities, not least because of the fact that you get a press conference with every single interest rate decision, but the way the ECB communicates can often lead to quite a few ad hoc trades that you can't necessarily see coming, but will provide surprise opportunities throughout the days, weeks, months in between meetings. You also get a question and answer session on every meeting with the ECB as well, which offers, again, further opportunity to dig into what their thinking is, and this way you perhaps get a little bit more information from the ECB than any of the other central banks. So let's go and have a look at the ECB, what their policies are, what tools they use, so you can familiarise yourself, and then again it will be an interpretation trade this time to practice your skills and trading that.
Sort of large directional move opportunities, scalp opportunities.
So a quick overview of the European Central Bank. It's established in 1998 to manage the euro area economy. It's one of the newest central banks in the world, and this is due to the advent of the euro. Prior to that, every European country had its own individual currency. So once that became centralised, you then needed a European central bank to manage that. In terms of their mandate, it is, much like many other central banks, price stability, but it is only price stability. And this is quite clearly defined in relation to inflation as a year-on-year increase in a harmonised index of consumer prices for the euro area of below 2%. So basically they want inflation below 2%. They will reiterate the point that they want to keep inflation below but close to 2%. They still want growth in prices, but they don't want this over 2%. So 2% is seen as a very hard line. It's not like the Bank of England that's symmetrical. It's a very hard line that the ECB intends to stay below at all times, and we use monetary policy tools to achieve this. Now, the way that these tools work is a decentralised situation. So the ECB will coordinate policy, change policy, but it's actually the individual central banks of each member state that carries out the transactions, so the open market operations within their individual state. So individual central banks still maintain some control, but ultimately they have to implement policy that has been created by the ECB. Let's go and have a look at the ECB board members. So with the ECB, there's a slightly convoluted structure. There's a governing council, which encompasses an executive board consisting of 6 members. These have permanent positions and will always be part of the decision-making process at any meeting. Any member of the governing council of the executive board will have an 8-year term. Outside of that, there's then the 19 heads of other European central banks. These make decisions on a rotational basis, so you would always have 15 of the 19 making a decision on any meeting. Now, what I do want to bring your attention to is the first 5 in the list on the left of the other central bank governors get more votes or more chances to be part of the decision-making process than all of the rest of them. This also skews the ECB towards the more northern part of Europe, with Weidmann being Germany, Lind Spanish, Villeroy French, Visco Italian, in fact, and not Dutch. So you can see where the skew is to the more northern part of Europe. Likewise, when you go onto the executive board, Draghi from Italy, Constancio Portugal, Kur France, or Kure France, Lautenschlager is German, Mersch is from Luxembourg, and Preyet is also German. So whether this has a bearing on decision making in the ECB is up for debate, and that is something that is more peripheral to the way they actually make decisions. Now, in terms of voting rights, every member gets a voting right. However, these are never published. The vote is never actually published, and the decision is termed as either unanimous or not. That is all that you get from the ECB. So it's more that a decision is come to, despite the fact that every member can have their individual input to that meeting. So take note of who's hawkish, who's dovish, and the other thing that I do want to point out, going forward, is when the terms end of some of the executive board members. We will see in the next year and a half, going from the beginning of 2018, Draghi, Constantia and Prayet all leaving. So the three top jobs, the President, the Vice and the Chief Economist, all leaving the ECB. Now all three of these members are reasonably dovish, if not very dovish. So this switch is likely potentially to switch to a slightly more hawkish ECB going forward. So just something to keep in mind and be very wary, or very aware I should say, of who is going to come in and take those positions. So understanding the hawkish or dovishness of other members can be very important going forward as you then start getting news on who will replace Draghi, Constantia and Prayet in the future. Right, let's move on. Have a look at the ECB meetings. As I've already mentioned, the ECB conducts 8 meetings a year, much like most other central banks. But the difference with the ECB is that they do a press conference with every meeting. Also, there is no pre-release of the statement either. So, rather than with the majority of other central banks, the statement comes out when the decision comes out. So, say rates change and then the statement all comes out together. You don't get a pre-release of that statement. So the statement is at the beginning of the press conference. So Draghi will read the statement. So as you hear it, it's the first time it's heard, meaning that any words, any changes within that statement can be acted upon in real time. Next up, you also get staff economic projections. These come about in March, June, September and December. This typically has been the time when the ECB will act if it is going to change any type of monetary policy tools. It's not a hard and fast rule, but changing when they have the staff economic projections is often
Okay, guys. So
a way that the ECB likes to go about things.
That you get over a central bank, and this is a position.
Much like every other central bank, there is a blackout period.
The whole premise of this
7 days prior to the meeting.
The market is pre-positioned.
However, and this is where again the ECB does provide you with numerous extra opportunities. You will often get unnamed ECB sources. So you will get an article or a piece of news comes out from an unnamed ECB source.
First up, you have
often giving a little bit of a clue as to what may or may not happen at the meeting. Now, you don't know the timing of these. These sources could come out at any time, so you should always be aware of them. We'll have a little bit more of a detailed look in a minute at how sources can affect the market and where those opportunities are.
This is similar to
so
the play that you got in the Euro.
We'll come on to sources in a little bit, but that blackout period from 7 days prior, so theoretically you will not hear any one member of the ECB speak in 7 days prior to the ECB meeting.
What can then happen is you get a stop out of those positions.
Format of the release. So what we have is 12:45 release. This is where you get the decision on stimulus, the decision on rates, and you will also get a brief explanation of those decisions, particularly relating to forward guidance. Again, we'll come on to this and look at it in a little bit more detail in a few moments' time. And then at 1:30, you get the press conference. This is where Draghi will read the full statement and then answer questions. This usually goes on until around about 2:30 UK time. This is where you can have additional opportunities to trade based on your interpretation of what Draghi says in that press conference, as well as his answers to certain questions. Previously, or I say previously, prior to the beginning of 2016, the ECB would only release the interest rate decision at 12:45.
What this then serves to do,
you would then wait until the press conference to get in real time all of the rest of the decisions and any forward guidance. Now, the way that the information is received varies depending upon your news source. So if you're watching it through the TV, on CNBC, on Bloomberg, on another news channel, likelihood is you will be around about 5 seconds behind those who have got the direct feed to the press conference. So be aware of that in terms of both if you've got the direct feed and you execute a trade, then it may take a few moments to actually start to move as everyone else starts to hear it on the news channels.
I've got 2 different examples here.
Conversely, if you are watching on a news channel and you see a quick move, this could be showing you that new information has come out. But once that information gets to you, you need to assess how big a deal is it. Are you still willing to trade off this information once that initial move has already happened? So something to really be very aware of, depending upon what news source you're using to listen to that press conference.
Now, considerations.
I've given you a link just below to all previous press conferences. ECB gives every press conference with Q&A going way back until the start of the ECB, so all of the previous ECB heads as well. So you can read through that. What I would suggest when reading through the ECB previous press conferences, you want to read the first 2 pages.
Where would those people get at?
That's where any change in language particularly comes up.
Where could that squeeze reach?
Understanding that, and you'll start to understand the very clear structure with which the ECB goes about its statements, and very clear how certain areas have changed. So watch that consistency or inconsistency when it does change. And finally, you get minutes from the ECB.
You could be looking there,
unlike the Bank of England, which publishes minutes at the same time as QIR, of course, the inflation report, and its rate decision, the ECB publishes minutes 3 weeks later. Generally, the minutes will just reiterate what happened at the Governing Council decision. However, there have been a couple of rare occasions where the minutes have actually been used or have actually been able to give a little bit of guidance going forward. And this particularly happened February 16, 2017. The ECB released their minutes, and we'll go on, have a quick look at the next slide. This is what you got from the minutes.
There's your first trade.
Basically, what the ECB minutes were saying was that there was potential for adjustment in the capital key. Now, you'll remember from the beginning part of the course when we talked about central bank preparation, how the capital key works. It's to do with the allocation of bond buys between different countries.
If you have a very binary type trade situation,
the thought is that if a capital key shifts, it is likely to favour the more peripheral nations, i.e. Italy, or the more southern nations in Europe, to the detriment of German bonds, because they are the most bought asset in the ECB's QE purchases. So the minutes stated that while significant weight has also been placed on limited deviation from the ECB's capital key, it's also underlined that limited and temporary deviations were possible and inevitable. Thus, there was some room for a trade-off between relative deviations from the capital key across jurisdictions and limiting the extent of purchases below the DFR, that's the deposit facility rate. So, basically, in order to not buy bonds from below the deposit rate, the ECB was willing to see slight deviations in the capital key. What this caused, and we'll go and have a look on the next slide,
is waiting for an access point to develop. You're not going to know exactly where
was a switch in a spread. So what happened is it gave an opportunity to buy BTPs, the chart on the left, and also to sell bonds. Now, the crucial thing to note here, BTPs on this comment went straight up 2 minutes, and the BTPs rose around about 100 ticks. The Bund in the first minute following these comments actually drifted up with the BTPs. You see that first little green candle before the 4 or 5 red candles down, and that's because the BTP shifts higher, the Bund gets dragged with it before realising the implications of the comment, And so actually you end up with a better opportunity of selling the Bund because of the fact it has been dragged up when actually it should be coming off. And the Bund then does turn and takes about 40 ticks to the downside. So offering you a very nice trade placement on these comments. Again, this is something that comes out consistently 3 weeks later, so you can be prepared for it. And much like a rate decision or a central bank decision, you can have your preparation done and be very ready for exactly what's going to happen.
They're getting themselves into long positions in the expectation that the Bank of England is going to suggest.
We're going to tackle the ECB toolkit in 2 parts. First up, we'll look at rates, and then we'll look at their extraordinary measures, of which they have got multiple. So all of these need a little bit of explaining. Now, the ECB has 3 published rates.
The other thing to take from
they're the main refinancing rate.
Is that going into it,
this is the rate for 1 week borrowing from the ECB. It's the main instrument for managing liquidity. So this is the rate that all of repos are based around. So that's their main rate, and it's currently at 0% beginning 2018. Next up, and a rate that's become very focused upon, is the ECB deposit rate. Now, this is the rate that the ECB pays on excess reserves. So banks have to hold a certain amount of money at the ECB. Anything above that,
so the market's now getting a little
the ECB will pay will pay interest on, but as is the case with negative interest rates, is in fact charging interest on.
Yes.
So the idea here is that the ECB is trying to push that money back out into the economy by discouraging banks to hold money at the ECB. They'll be charged for it, and so therefore they should theoretically want to shift that money out into the economy and use it in other types of lending that is going to yield better than negative 0.4%. Finally, you have the marginal lending rate, and this is the amount of interest charged on overnight liquidity. This is a bit like the Bank of England discount window facility, so this is the sort of lender of last resort facility, whereby liquidity will be provided against eligible capital
expectation is
9-0 at a slightly punitive rate, or a rate above that with which repos are carried out. Now, the eligibility for this collateral, the ECB has consistently dropped. It was previously AAA collateral. It's then been dropped and dropped and dropped to allow central banks and commercial banks within the euro area to actually access this facility. So that's been the ECB, again, a sort of attempt at shoring up the economy and averting a crisis by allowing weaker and weaker collateral to be used for marginal lending facilities. And finally, in terms of guidance on rates, the ECB has used a very familiar or very well-used line to explain their guidance on rates, that their rates will remain at present, and in the past it has been present or lower levels for an extended period of time. That extended period of time is then either in reference to asset purchases or in reference to inflation rates. So, whilst asset purchases are ongoing, the extended period of time is well past the horizon of asset purchases. With no asset purchases, that extended period of time will relate until a progression of inflation back towards their close to but below 2% target. So there are your 3 rates from the ECB. Focus recently has been predominantly on deposit rate. However, the main rate is that refinancing rate, which has fallen down to 0.
When you get in, because that's the other really important part.
If we go and have a look at how these rates have progressed over time,
how exactly does that move play out?
Be aware there's 2 axes on this chart. So the main refinancing rate in orange and the deposit rate in purple go down to different levels, 1 to 0, 1 to minus 0.4. So always maintaining that range between the two.
You're able to sit with it. But if you get into
again, much like the Bank of England, we saw a very quick move, fast drop during 2007. The ECB, though, because of their mandate relating to inflation, actually began to raise rates in 2011, way before any other central bank. This was because inflation was actually starting to creep up above 2%. Those rates were raised, but the European Union then fell into the European debt crisis, and this caused, when Mario Draghi took over, who is the current head of the ECB, when he took over, he then started cutting rates very quickly to provide some stimulus to the economy. So the ECB actually went contrary to other central banks in raising rates in 2011, and then again contrary to other central banks in continuing to lower rates throughout 2011, 12, 13, 14, 15, and even 16. So ECB is often slightly off kilt with other central banks, but you can see the progression of rates. And you can, again, see the ferocity with which rates can be cut if stimulus is needed. Central banks now, however, have got interest rates near the lower bounds and near zero. Can they actually decrease them any further? And where would stimulus come from, should the need come in the future?
As it jumps up, you can fade it on that very fast move. Now, the difficulty
beyond interest rates, the ECB has multiple other ways of providing stimulus to the economy. First up, there was extraordinary measures. These began in 2011 and took the form of longer-term repurchase operations. These were done at a fixed rate, which meant that whatever borrowings a bank took on wouldn't be affected by any movement in interest rates from the ECB. So there's your longer-term refinancing operation, and they were done for a fixed amount of years as well. So it was yearly repurchasing operations as opposed to the weekly version that is more typical from the ECB. This was then advanced in 2014 to targeted LTROs. And again, these were done with the intention, a lot like the Bank of England, of that money needed to be lent out in order to gain access to these TLTROs, as they were termed.
So there's your quick first.
So both operations were for 3 years and then 4 years, and the idea was that it would ease credit conditions for the private sector and households by providing additional loans because of the targeted nature of these LTROs.
Remember, this is also a market that has traded
Once this had come into play, the ECB then started to embark on additional purchases. We had the covered bond purchase program and the asset-backed securities purchase program in October and November 2014. These are basically a precursor to the ECB buying additional securities, buying government bonds. However, the idea was always that the ECB would buy these, and these transactions would be sterilised, i.e. they would buy the asset-backed securities from commercial banks, but then always with the intention of selling them back. Come March 2015, that's when the PSPP started, Public Sector Purchase Programme. So the ECB, you'll probably have noticed by now, does like an acronym. So be up on what each of these do mean. PSPP, Public Sector Purchase Programme. This was where the ECB went out and bought government bonds. Now, as I mentioned, it was the individual central banks from each country that would do the buying of these bonds, not the ECB itself. The bonds then all did sit on the ECB balance sheet. However, it was the individual central banks that took on the task implementing this policy. Finally, March 2016, we then got the CSPP, which is a Corporate Sector Purchase Programme, which was in addition to the PSPP and was purchasing of corporate bonds from non-financial corporations. This created an interesting situation whereby certain car companies, because they earn a fair bit of money from financing loans to buy cars, actually couldn't access this or couldn't have their bonds bought. So just a little nuance there for you to think about. Now, conditions of these additional purchases, PSPP, CSPP.
So once that breaks,
they couldn't buy any more than 33% of an issue or an issuer's bonds. What that means is that any one issue of bonds, the ECB can't buy more than 33%. Also, from any one country, the ECB can't buy more than 33% of their bonds.
So that's how you'd be looking to try and play.
Bonds must be bought in accordance to the capital key.
Two opportunities.
So what this again led to was a surge in buying of German bonds because of the fact that they had the largest percentage within the capital key. Bonds were bought with a maturity of 2 to 30 years, and they couldn't be bought below the deposit rate. Now these were both changed in 2016. This was to counter a scarcity of German bonds. Because of the fact that German yields had dropped below the deposit rate, the ECB then couldn't buy enough German bonds to stay within the capital key. And also because of the issuer limits, they couldn't buy more than a certain number of bonds from any one issue, leaving them with a scarcity of German bonds to buy that actually yielded above the deposit rate. They dropped that deposit floor in December 2016, as well as the maturity, so they could buy a lower maturity, i.e. 1 year bonds. So that's their extraordinary measures toolkit. Go and have a little look at the next chart, and it will show you exactly how this was played out throughout the months.
Fade point. A clear sort of reference point.
So, ECB, unlike the Bank of England, who had a maximum target of purchases, merely had a stated monthly purchasing amount. So this started off as 60 billion in March 2015, and you can see every month 60 billion was bought. This then got upped in March 2016 to 80 billion a month.
Here we're going to look at
before then being lowered back down in 2017 to 60, and then going into the end of 2017, the announcement that it would then be dropped to 30 billion a month. So there's a consistency in how much they would buy each month. Also, something else to note is the way the ECB's purchases dip in July and November. This is preemptive of the limited liquidity in summer markets and also over the Christmas period. So what would happen is the ECB would front load purchases prior to July and then reduce the amount of purchases for that month and then backload them again just after July, likewise in December as well. So you can see where the majority of purchases have been made up, pretty much all from the PSPP, and then a smaller part added on from the CSPP. The other earlier purchase programs, the CBPP and the ABSPP, reasonably limited in their impact on the ECB balance sheet and their increased purchasing each month. So the real big stimulus did very much come from the move in March 2015 to boost QE and actually push that into government bond purchases.
60 to 50 range. So that's going to be your main target on this. Now,
understanding how the ECB communicates its rate decision is crucial. It comes in a reasonably consistent format, and this comes at 12:45 on the first release. So what you'll get here is you'll get the decision made, and then also certain elements of forward guidance, taking away a lot of the opportunity from the statement. However, there are still quite a few opportunities there, and we'll talk about that in a little while. So first up, you get the rates decision. Note here, look at the time that it comes out. It is not often bang on 12:45. This 12:45 in 21 seconds. So you'll get the rate decision. The ECB will state whether it is unchanged or raised to or lowered to on each of the different rates. Next up, you get the asset purchases. This is a statement regarding the asset purchases, how much they are, when they're intended to continue until, and the final caveat that the ECB puts in is all beyond if necessary. What this means is that asset purchases are open-ended. Effectively, they will buy until a certain date that they specify, However, it always leaves the option that they could go beyond that, and they could then extend the duration of purchases out a further 3, 6, 9, 12 months, however much they decide. So that line of beyond or necessary, or beyond if necessary, is very, very important. So that's the first part of their forward guidance. Next up, they have guidance on sequencing. And this is where I mentioned before that reference to interest rates remaining at present levels for an extended period of time. This is the key guidance that the ECB gives.
Is a 7-2 vote
throughout the asset purchases, as I mentioned previously. This always related to the end of the asset purchases, so well beyond the horizon of asset purchases. So in this example, beyond September 2018 and well beyond that. There's no specifics on what well beyond means, and that's where the market interprets it and may push well beyond out to a year beyond, 6 months after the market decides to interpret it. But that's the key bit on sequencing, the at present levels for an extended period, and then they will relate those present levels for an extended period to either asset purchases or inflation.
Another interpretation element,
and finally, you have the contingency.
1.5 hikes.
This, as you'll note, I've just boxed off the time there, comes slightly later. You usually get this a couple of seconds later, so you get a little bit of time to assess the first information, and then you finally get the contingency on asset purchases. And this relates to inflation and the outlook if it becomes less favourable, and conditions become inconsistent with further sustained growth of the path of inflation, then the Governing Council stands ready to increase asset purchases in terms of size and or duration. So what this does is it not only have they already said that it's open-ended, that they could continue with the purchases indefinitely, effectively, but also that they could adjust the size and or duration, meaning that they could re-increase asset purchases at any one point. So again, the way the change in asset purchases happens is very crucial. Can they still increase size? Can they still increase duration? So it's how the asset purchases are referenced and what exactly they're saying that they could do in relation to their asset purchases. So that's the first key part of communication, the rate, and then the guidance on those specific areas, the asset purchase program, sequencing of rates, and then their contingency relating to asset purchases going forward.
In 3 years' time. That doesn't suggest 3 hikes over 3 years.
Okay, let's have a look at a standardized format for statements for the ECB. So this is their normal way of communicating. This is what you'd expect on most ECBs, as long as they have not changed monetary policy, in which case the format of the statement will come up slightly different. Generally, you'll see the first paragraph, Mario Draghi, or the head of the ECB at the time, will reiterate their decision on rates, on asset purchases, and any sequencing. It's in the second and third paragraph that you get their assessment of the economy, and this is where there is additional opportunities for a trade. So what you'll get is you'll get an outlook on the economy, and the focus here is on growth, inflation, and monetary accommodation.
Next up, you're then looking for
the key references are to underlying inflation and to monetary accommodation. So let's go and have a quick look at July 2017.
And this is what I mean about trying to find your access point.
What happened is, in the second paragraph, the ECB statement described continuing strength of the economic expansion, which has been broadening across sectors and regions. The risks to growth outlook are broadly balanced. So that's their assessment of the growth outlook. So there is always a phrase after or just before the growth outlook to explain whether it's broadly balanced, whether it is improving, whichever it may be. And it's the change from the previous statement that is the key here. Is this becoming a more hawkish slant or a more dovish slant?
Bought it on the decision.
Next up, you're looking for reference to inflation. So headline inflation is dampened by weakness in energy prices. Moreover, measures of underlying inflation remain overall at subdued levels. That's the key area, it's that underlying inflation and their reference to how it is progressing. So in July 2017, it was at subdued levels. And therefore, and this is where generally the relation to monetary accommodation comes in just after that inflation outlook. So therefore, a very substantial degree of monetary accommodation is still needed.
And so the 131.10 then becomes...
So that's actually very standardized where the ECB does things. You get the general change or technical issues, then followed by the information regarding the economy and how this is likely to affect monetary accommodation going forward.
Give you a passive continuation trade. So that's your third opportunity that you play in the passive trade as you break 10.
After the general explanation and general talk that you get from the ECB, if they want to signal that they are going to do something in coming meetings, the ECB tries very hard to be very transparent, tries very hard to make it very clear what they're about to do. They will often use certain phrases to tell you that at the next meeting something is likely to happen. What exactly that is, you don't know. But understanding expectations going into a meeting will give you a pretty decent clue as to what is likely to be coming if they transmit to you that they are likely to do something in the future. So the way that they've done this is they talk about preparatory work, and it follows a bit of sequence here, but they will often talk about preparatory work first. So in November 2014, this was prior to the beginning of QE,
as to how exactly this
ECB staff and relevant Eurosystem committees, ECB has tasked ECB staff and relevant Eurosystem committees with ensuring the timely preparation of further measures to be implemented if needed. So it's this tasking of committees and preparatory work that signals that perhaps sometime down the line we're going to get an indication of a further change in policy. The next meeting following that November meeting, December, they actually stated in the statement after the economic assessment that in this context, early next year, the Governing Council will reassess monetary stimulus achieved. Now, it's that reference to reassess or reevaluate that is key. If they use that phrase, it is very likely that you're going to see something change in the next meeting. Now, how does this play out? It doesn't mean that you wait till the next meeting. The market will act right there and then. So picking up on these little phrases, these key words that pop up every so often, will give you a trade. And you know the direction. If we're moving towards a more dovish stance, i.e. greater stimulus, then the move is likely to be a dovish move. So a push higher in bonds and move higher in stocks. They go on to say they'll reassess monetary stimulus achieved, the expansion of the balance sheet and the outlook for price development. We'll also evaluate oil prices, and should it become necessary to further address risk too long period of inflation, the Governing Council remains unanimous in its commitment to using additional unconventional instruments within its mandate. So basically they're saying that they're going to reassess next time, and if need be, they have got additional instruments that they could well use. So this is their way of communicating forward, trying to be transparent in what they're going to do going forward.
Any continuation? No. So what we've now got is a range that we're waiting to see the break of. Now, from a technical point of view, those shorts could well now have been viewed as being squeezed out, and we're then going to get...
So following on from that note on reassessing in December 2014, the ECB then delivers action. This is how it comes up in the statement when it's not a standard statement, when you get action. And note the format here. First paragraph. Based on regular economic and monetary analysis, we conducted a thorough reassessment. Usually the first paragraph starts by talking about interest rates, starts by talking about asset purchases that they're currently doing. The fact that they don't go down there and they go straight in with talking about their reassessment gives you an indication that they have done something, that they are about to change something. And then the next paragraph begins with first, and they will then list the things that they are going to change or implement going forward.
back up.
So it's all about how that changes in that first paragraph. As soon as you hear, based on our regular economic and monetary analysis we conducted, you know that it's not normal, that they are going to do something different, and you're going to hear about it in the coming paragraphs. So that's how that's communicated,
and we find some buying quickly.
all about the phrasing of those paragraphs. And this is the reaction that we got.
We don't break 19s. If we get
Bund surged on this news, and actually if you look at that total move, we saw around about a 200 tick up move in the Bund. This is a 1 minute chart, so it's a very, very strong move higher, a bit of a pullback followed by an equally strong move higher again, over the course of around about half an hour. So a very short time scale to get a very, very large move that is very sustained, because of the fact that they have come out and basically said that they are going to do asset purchases. But this all came from that preamble in November and December that gave you the clue that they were going to do something at the beginning of January.
Still a potential opportunity. Those who are long are still feeling they've got a little bit of comfort.
Final chance in the press conference for Draghi or the head of the central bank to get across any policy measures that they don't feel the market has absorbed properly is in the Q&A.
So we're back into
this has often been used to either bring in new ideas or to reiterate points that the market has perhaps not taken on in the statement. So there'll be numerous questions for around about 45 minutes. And one of the questions here from 2017, did you have any preliminary discussion today, and did you discuss options for future of QE?
Take a bit of time before we get.
What Draghi comes out and says is that the Governing Council will ask for, or will want to see, work by committees that we've tasked to continue working, but also points out that rates will stay as they are at present levels. So he gets a chance to state that they are looking at doing more, the preparatory work, so potentially we know that something could be coming up in the following meetings, but also reiterates that it will not be in relation to rates. Next up, you then get a question, could you right now commit that we would know the decision about the future of the QE programme in October, or will it be delayed even further until a December meeting? Draghi goes on, and this is where he sort of pushes away certain questions as well. Governing Council reiterated it's this fall as a period when these decisions will be taken. So they often will use a vagueness to get around decisions. However, he then goes on to clarify and says probably the bulk of these decisions will be taken in October. Therefore, you know that come October, we are likely to get some news predominantly regarding the asset purchases, because he has already stated that rates will stay as they are at present levels for an extended period of time. So it's this question time where he can throw out a couple of little bits of extra information, or want to clarify or push the market towards focusing on a certain thing. The majority of questions, Draghi can be very forthright and say, no, this was not discussed, or say, no, I'm not answering that question. So he can just bat away questions. But if they want to get information across, it can often come across in the questions. Focus is key here. Questions can go on for 45 minutes, and you could end up with a lot of questions that are reasonably irrelevant or very country specific, depending upon where the questions are being asked. It's the key questions that you want to be focusing on. As long as you're ready for that, then there is still a trade in the offing for you. All right, so we're going to have a look now at ECB sources and where the opportunities lie there. A major tool that the ECB uses in terms of communication is their sources. Now, theoretically, no one knows who these sources are. They're always unnamed sources, and whether that be a member of the Governing Council, a member of staff, no one knows. The point is you don't need to know who it is. The sources generally will give a bit of guidance going into any ECB meeting as to what could well be about to happen. It has also been postulated that these can be a sort of testing of the market to see what the market's reaction is to a certain change from the ECB. And so they can then decide whether it's warranted at this time or whether to perhaps go against the sources and wait a little bit longer. But the big benefit of sources is they are totally ad hoc events. It is an interpretation trade, of course. But the key thing here is if you understand the direction the ECB is currently moving in, or the potential additional changes that could be made, this provides you with an opportunity. You can almost be ready for the sources. You can't ever know when they're going to come, but you can have an idea of what potential sources could come out and be ready for that and know a certain type of trade or what you'd expect the market to do if you get a certain type of sources. So this was back in April, and what people were starting to wonder, and this is April 2017, was could the ECB shift their policy message, so shift their forward guidance at the April meeting, guiding either rates or guiding the asset purchases going forward. Now, because of the fact that the ECB had already drawn back on purchases in December, any kind of shift in policy was likely to be a more hawkish slant. So with that in mind, if they say that ECB policymakers are wary of making fresh policy message shift in April, then the Bund takes a rather dovish move and we get a full, in this case, 65 tick move, and this took around about 4 minutes to play out. Now, with sources, one thing that is very worth remembering, initially and quite often you will get a first jump, and you can see this, the smaller green candle before the much larger couple. You get a quick jump and then a bit of a pullback, and this is where the market perhaps is waiting to see if there's any more sources. Also, for people who've not got the sources, it's a sudden jump out of nowhere, which generally will get faded back. So if you get the sources, interpret them, and you have to stick with the trade if you believe it is something that is fundamentally changing the picture for the ECB going forward. But as I say, frequently the ECB will put these sources out. I would suggest perhaps once a month you may get an opportunity on ECB sources. The severity or the scale of how much they move varies depending upon what the sources relate to. But they do provide ad hoc opportunities, and it's all about keeping up with where the ECB currently is and where their next move is likely to come. And that's what helped this April move. It was all about the fact that their next move was potentially going to be a more hawkish shift. This completely took that hawkish shift away, and you got a 60 tick move in the Bunds for it. We're now going to give you a practical look at trading ECB sources. Now, to give a bit of context, and this is always the key thing with sources, it's all about the context prior. The chart that you can see on the screen is a chart of a press conference given by Mario Draghi at an ECB economic conference in Sintra, which is in Portugal. Now, what seemed to happen is Draghi changed the way his wording of a few things. He used the general same format that he would use in a normal ECB statement. However, he put in a few different phrases. He suggested that all signs were pointing to a strengthening and broadening of recovery in the euro area. That was a pretty standard phrase and one that is generally used in their press conferences. However, the phrase that he did then use was deflationary forces have been replaced by reflationary. Now, the ECB's fear for a long time was of deflation and had not talked about reflation coming in or an increase in inflation in the euro area prior to this. So this appeared to the market to be very new information. This did coincide with a technical break as well. So if you have a look at where the arrow is on that chart, we've got a trend line break and the break of a low as well in the Bund. So from a technical point of view, this made sense for a fall. However, the comments that Draghi made added to the severity of that fall, and the Bund fell from 165.10 all the way down to 162.78. So a full 230 tick move based around these comments. Now, from the technical point of view again, if you look at the chart, the move down didn't have any pullbacks. It was very forced on the move down. And so what this is suggesting is that if the market does start to come back up, there's a lot of scope to take out a lot of those prices because of the fact there's no clear reference points that would offer you any resistance on the way back up. So a little bit of a technical context there as well for you. The market has then ranged for the next day, and that's what you can see in that bottom part where you get the up and down piece. That is the range from the following day. So that's setting you up to trade these sources. Now, as I said, with context being so key, the ECB has in the past, and this is where understanding the ECB in a little bit more depth, has often contradicted any comments that have caused a large market move. So this very large move in the Bund, there was always a thought or always a plan or discussion on the trading floor that they could potentially release sources that contradict the move from yesterday, i.e. dovish sources. This is always a possibility in the next couple of days and something that we are all very, very aware of and ready potentially to trade. Here we go then, a look at those sources. Now the ECB will often attempt to contradict any comments that have perhaps caused an outsized market move or what it perceives to be an outsized market move. Now the 230 ticks move the previous day in the Bund was a very large move, and so there was always potential that the ECB could release sources that contradicted Draghi's comments and therefore brought the market back up. So this was something we could be entirely ready for and was discussed on the trading floor that morning, that there could be something that basically said the market misinterpreted or some phrasing to that extent. So you could always be ready for it and you knew exactly what the trade was. Because we had that forced move lower, so very few reference points to stop out on the upside, there was a good possibility of the market surging very quickly if we did get any source comments. If you have a look at the chart, you can see exactly what happened. I'll explain those comments. Basically, the first comment was markets failed to take notes of caveats within Draghi's speech, and also that the comments intended to prepare markets for a decision on stimulus later this year without making firm commitment. So no firm commitment. What this is saying is that even though he's talking about reflation, this is not going to impact any of their monetary policy, at least until later on this year. Now, another little technical reference for you, and for when you're trading this, these are areas that I want you to note down or watch exactly what happens. You've got multiple single prints. For those of you who don't trade market profile, single prints, areas where you have one letter on the profile, tops of each are often seen as resistance areas or areas that the market could at least stop at to start with. So those single prints, when you're trading this, come in at 163.62, 82, and then the final single print, so the last single print, 164.03. Now, you can see what happened. This is a 1 minute chart, so an extremely fast move. So the whole idea of this exercise for you is not to get on the move necessarily, but that is what you're aiming to do. The point is to learn how the price action works. So does it slow down at each of those single prints, and does that offer you a way to get into the trade? Remember, you're unlikely, unless you happen to be looking right at your newsfeed at the time of the sources, you're unlikely to be in within the first few ticks. So where is it that you can get in? That's what you're looking at. And this is a chance for you to practice your debrief that we spoke about in the earlier part of the course. So go through it, have a look particularly at how it trades at certain areas, and also what is very typical on very fast moves is an opportunity for a reversal trade as well. So look out for what it is when we get to those highs that offers you the chance to reverse. Is it just the chance to sell at the high, or is there another point lower down that you can sell and see the market accelerate lower? So think about all of these things as you're trading it. The idea here is to get used to the price action, to get used to the speed with which it moves and how the market moves from very quick surges to slightly slower trade, and then quick surges again. So take note of those, become accustomed to it, and this will help you out for the drill that is coming up next. Okay, so when executing on a piece of news, so this is a surprise piece of news. It's not a piece of news that you could have expected at a certain time. This is a sources comment, comes out whenever it comes out in the middle of the day. But with any kind of news execution, there's still a process to go through. There's still a format and questions that you need to very quickly ask yourself. So the first thing you need to be considering is, what does this mean? In this instance, it's a sources comment. It's counter the move that we got the day before on Draghi's speech at Sintra, that then should begin to turn some of that move around. The next question is, how big a deal is it? In this instance, a pretty big deal. It's taking back some of what was said. When we go and look at the sources in a moment in a little bit more detail, you'll see how actually perhaps it's not that big a change. This then starts to help you decide how much size to trade. If it's a really big deal, then this is where you're looking for a full size trade and the opportunity to hold on to it. What you've also got to be asking yourself is, what is the scope of this move? Now, this is what makes this such a large move. The market doesn't have a great deal of resistance in it. All the way down from the recent highs, there's no major pullback. There's no area that you could say, yep, that's a resistance point. So that means that there's very little to stop it once the market starts trading back up. Going over to a profile, you've got the single prints, and so each set of single prints, as mentioned previously, is going to be an area to be looking for. So 60s, 82, 93, and then the final set of single prints inside value up at 164.03. So they're going to be the areas to be looking for. The other thing to be thinking about is the positioning from the morning's trade. Everyone's sitting in this tight range down at the low, so lots of new shorts trying to play for this move. So you've got an idea of whether it's a big deal, or you will be trying to answer that question very quickly and then think about the scope of the move as well. How far can this really go? As I said, up towards those single prints looks like a pretty decent area. So they're going to be the questions you were trying to answer very quickly. Now, this sounds like a lot to answer in an instant. But if you're trading this market through, just by trading that day, you're going to have a sense of where the market is, where it could start turning back to. You would have considered, if you start any move higher, whether these single prints fill. So you're going to have an idea of where those areas are. You're going to have an idea of the scope of what could come from this, because the fact you will have assessed the way the market's trading. So a lot of these answers will come straight to you because you're going to know how the market is currently set up. The other thing to take from this is that the ECB quite frequently will give a sources piece if the market, in their view, overreacts to any one comment, and in this situation this would be seen as a rather large overreaction of around 200 plus ticks. So that's in terms of
what does it mean? Is it a big deal? The scope of the move. Next up, you've got to consider your execution, and your execution when you're onside. So what you've got to think about is, how do you get in? As soon as you get a piece of news like this, what you want to be trying to do is get one clip in. What you've got to ask yourself there then is, are you in early enough? Have you got in at the beginning of this move? If you have, then that's the chance to add more, and the speed with which you add really matters. The aim should be to get as much size in as possible early on. The longer you wait for it, the more you skew your average price higher and higher and higher up the move. This puts your skew in a bit of trouble, because it means that only a marginal pullback will be enough to start getting you out or start putting you offside on that position. So you want as much size in as fast as you can. If you're getting in later, then it's a situation where you don't add as much size. The other thing to be considering once you're in as well is, where do you scale out? Do you scale out each time it stalls, or do you have a major target or a larger target that you're going to be aiming for? In this situation, you'd be watching at every resistance, at every single print point, looking for whether the market has a little pullback from there or not. If it doesn't and it surges through, then that's another tick in the box of hold on to your position. The other thing to be thinking about as well is, where can you add on to this? Can you add on as the move keeps on going? Or is it a case that once you're in, if it moves a long way away from where you first got in, do you still want to be adding at significantly higher prices? That's all on the positive side of things. The other thing equally as important though, what happens if this goes offside? What happens if you have misinterpreted the news and the market doesn't move in quite the way you expected? Well, this is what you've got to be thinking about very quickly, is if ever you hit a piece of news like this, a sources comment, an ad hoc piece of news, what you've got to be thinking about is cutting your risk back to something manageable if you go offside. What you don't want to be is sitting full size, going offside to a point that you're not comfortable with, but you feel you can't take that loss because you've got so much size on that trade. So the aim is to scale it back very quickly to an amount that you can manage. You can always add it back in, but what you don't want to be doing is carrying a large position a long way offside. The other thing to be thinking about as well is, once you've scaled back, make sure you're focusing on what the market's doing, not what the position is that you've got. If you're then starting to trade in a small range, and we've looked at this from a positive side of things as well, if you're starting to trade in a small range, what you can then do is use that range to add position and take it out, add and take it back out. That way you improve your average price and still give yourself the chance to get yourself out of that main position. So there's an opportunity to work a position a little bit here. These are the things you've got to consider when you have a news event like this. What does it mean? How big a deal is it? When in terms of your execution, once you're in, where are you going to get out? Do you scale out? Do you hold? And also the other really important question is, have you got in early enough? What you don't want to be doing is jumping in later on if you've already missed the move. We'll go and have a look at how this applies. First up, taking in the news. So as we saw before, the sources comments were that the market failed to take caveats of Draghi's speech, suggesting that the market basically has overreacted, and that the comments were intended to prepare markets for a decision later on in the year without making a commitment. So what that's suggesting is that people have overdone their reaction. They should be taking some of this back. And you get the move that stacks up exactly to that. So here's the move. What I'll do is I'll also replay the ladder so you can see the pace of this move here as well, and where you would want to be trying to get in, how it stalls at certain areas. So I'm thinking particularly around 60, around 80, and then also where that reversal opportunity is. As you get up there, of course you're not going to know this, but you're going to know the levels to be looking for, and then there's a very clear reversal opportunity looking from a ladder point of view. So let's go and have a quick play of this and we can see how the market reacts. We're trading currently 163.20, so inside the day's range. 163.36 is the key area. That gets you into the single prints. Here's the news. So as long as you can get in around here, 36 to 40, that's the area you'd want to be trying to get in. Getting in much later, and we've already now seen a 45 tick move within about 10 seconds. This is not then the area you would want to be adding significantly to your trade. But straight through 60s, your next target's going to be 82, the next set of single prints. And again, straight to it. This is a chance to scale out. But the fact that we're not dipping back down, and the fact that you're not moving back through the low volume that's established at 78 is a reason to then think we've got further to go on this move. We're now up towards 92, the bottom of value, and try to add on once more. Still holding these low volume areas, but as soon as that comes back, those adds you should be trying to take off. If you've been adding above 90, you don't want to be holding that and carrying that position back. So right now we've moved up 75 ticks in under a minute. This is now the point in time where you're starting to think, how much further can this go? What is the scope of this move? The last set of single prints comes in at 03s, and you can see this large order sitting up at the highs. That's a prime opportunity for a reversal. This has been an extremely fast move in a very short period of time. So if anyone's going to be taking profit, this is an area where people could well be looking to take profit, and this can create the reversal trade for you. What you're now looking for here is areas for this to fall back, and you've got a couple of very clear zones to be looking for. You've got the low volume down at 88s, there's your first target, and you've then got this low volume once more down at 79s and 77s. So they're going to be your targets on a reversal. Now remember, if this is a reversal, it's not necessarily just going to shoot back. Not often do you get a market trade up a full 80 plus ticks and then reverse in a dead straight line as soon as it hits a level. What's happening at the moment is people are buying. People are trying to get long for a continuation of this move higher, which is why we then find short-term support around about the 163.92, 93 area, which keeps the market testing up. If you've taken a short here though, you have got the security of the large order. You've got a large order at 06s. A stop beyond that gives you some safety. If you're short 03, it's a reasonably tight risk, and particularly if you're long all the way up to this, then it's a rather small risk to be taken back. So you see, once again, holds around the 97s, still holding around the 03s, and what you're waiting for then is a break through that 93 area. Then that's going to give you the further move down that gets you right the way back towards the 82s. Now, in terms of how you're going to manage this position, it could well be that you try and scale out just around the 93s, try to take a little bit out of the position as it starts to pull back. You can still add as it goes through 92, 93. You see here an attempt at adding at 95 to try and get a little bit more size in, still scale at the same position around 90s. But by adding at 95, where we have now started to fall back and we're stalling at 95, the market's not bouncing away from this as fast as it was originally. So now that we're stalling here, this is a chance then to get in a little bit more, still scale some at 90, but you then, what you scale at 90, you're still able to hold pretty much the same size you originally had, all the way down towards the mid 80s and even mid 70s. So you can see the amount of volume being done at 94, 95. This is where you're getting a battle. Some people are still trying to buy this for the continuation higher, even though we are 75 ticks higher than where this move originally started a few minutes earlier. Others trying to sell, using the liquidity of the buyers to try and get out of long positions, sell into those new buyers coming in here. So this is your tipping point through 94, and we start to fall. If we can get back above 95, 96, 97, then the buyers are starting to win, and that then can progress the move higher, start getting the turnaround and the continuation right the way back into the previous day. Starting that dip down, now trading 92, 91, starting to get out of the position here. Remember, this is a reversal trade. You're just trying to take a bit extra out of the move as people start to profit take. We get down to that first area of low volume around 88, 89, but still, even when you get a bit of buying from there, the sellers come straight back in very quick. This is what you're looking for if you're already short. If you're playing that reversal, and if you're trying to get in, selling around 90 now would be the place to try and sell. You're then looking for a move down through the mid 80s, down into the mid 70s to get you out of this reversal trade. It's not a trade that you're necessarily going to try and hold for the entire move back, and more a trade that you're looking just to play back into the mid 70s. This is an opportunity to take an extra 20 ticks out of the trade from what was a very, very safe entry, because you had that size that offered you that very tight stop. That down in towards the high 60s, that's back onto those old single prints and decent area to be exiting your trade. So that's the way you'd be looking at trying to trade these sources. Now, they're not always going to come out exactly the same, but the key takeaways from this were the very fast move up and making sure that you've got in early. As long as you were in before we broke the highs of the current day, so before 163.36, that's where you could be looking to try and add the most size. You're then looking for the move all the way through those single prints as well. Because of that very, very poor structure on the way down, there was no clear resistances. So the only things you've got are the single prints on the way back up. Each one of those could well offer you a bit of resistance, but as soon as it pushes through each one, you'll then straight away look into the next single print for your next target. So you first had the move through 60s, then through 80s, up toward 90, and that was where you got the first pullback around 90 to 80. Once more though, onwards all the way up towards 03s, and then you got, this is something to take from the price ladder rather than anything technical, but you've got that large order resting there waiting to get filled. This provides good protection if you want to have a go at front running. One, to get out of your long position if you're in on that original sources comment, but two, it provides you a rather cheap stop for a short position. Remember, there's going to be a lot of other people long here thinking to themselves, yes, we're going to get a big move. As soon as they see that large order, they're then going to start profit taking. So what you're doing is you're taking money as people start to profit take, as people realize that the move isn't going any higher, as they start to sell 02, 01, 00, 99 to try and make sure they bank their profit. You're then capitalizing on that by entering that short position, looking for that shorter term reversal. Once you then consolidate above 93, that offers you the next area where either we're going to hold 93 and keep the move going, or alternatively 93 breaks and the move then reverses right the way back down towards those old reference points. So numerous trades to be taken there, and this is a slightly different scenario of a more news execution rather than a trade that has a distinct time that could have been played on. Like any other central bank decision, this is not going to come at a specific time of day. It will come ad hoc during the day, and so you then have to react quick to it, but you need to have that process in mind of how exactly you're going to react. That way you don't hesitate, and that way you know exactly what you're going to do once you've got that position. So make sure you review those execution points in terms of how far it can go. Have you got in at the right point in time? Where do you scale? Cutting your risk back as well. If it's not going your way straight away, don't sit there with a large position that you're going to be uncomfortable if that starts to then go offside. Bear these things in mind for the trading drill which is coming up, and good luck with that.